maybe we could start by speaking about your views on how inflation is still too high in most developed countries, yet to justify a meaningful cutting cycle. So, how is elevated inflation yet in Europe, the UK, and the US?
Well, we've gone through an interesting period here where basically, we had a lot, there's COVID, there were supply shocks related to COVID. There was an elevation of price growth as a function of those supply shocks. And in general, developed world economies provided some sort of stimulation, some sort of fiscal support so that spending could continue despite the fact that, prices were rising much faster than wages. But we've sort of settled into a point over the, that was really 2020, 2021, and a little bit of early 2022. In the last 2 years, we've really settled into a point where wages have finally caught up with price growth, wage growth with price growth. If anything, are a bit positive, more than price growth, and are growing at a relatively elevated pace, certainly relative to pre-COVID levels. Depending on which economy you pick, it might be 1, 2, 3, or 4% higher on a nominal year-over-year growth rate than pre-COVID rates. And that's coming at a time when the structural productivity of most developed economies hasn't really changed much since COVID. I mean, there's hope, and I don't want to diminish the fact that it's certainly possible that 10 years from now we'll look back at AI and other automation strategies and say that was a great innovation. It's not in the data really today in a meaningful way. And so you have basically a lot of nominal wage growth, not too much productivity growth. And the reality is the gap between those two things is basically has to be what structural price growth is, which is, if I pay somebody a certain, if someone's nominal wage is growing at a certain pace and their, per hour, let's say, and their output per hour is growing at a meaningfully slower pace, then the gap between those two things basically has to be resolved through changes in prices. And so that's essentially what we're seeing across the developed world. In the US, we've had flat productivity for the last couple of years, and nominal wage growth is growing at 4 or 5%, depending on how you think about it. We've had the same is true in Europe. 3 to 4% wage growth, flat productivity. The UK actually wages growth is even higher, and so it's not surprising that we're seeing inflation that continues to be elevated relative to what those central banks' targets are. And so, and that without resolving sort of that core thing, either productivity has to rise or wage growth has to slow in order to resolve the structural inflationary pressures, or we'll sort of stay here where we're at, which is, it's not like inflation the way it was 2 years ago, but inflation is still above where those central banks' mandate exists.